Good morning, all. Sometimes proposals which are put in the finance bill do not consider the existing provisions of the law, at least it appears thus. We will discuss two such fine prints over here. Number one, going forward from 23rd of July 2024, there is not going to be any indexation benefit under any long-term capital gains calculation. This brings in a very anomalous situation. Let us understand the anomalous situation using two existing sections, which is section 51 of the Income Tax Act and then 56(2) subclause 9 of the Income from Other Sources section. Under both these sections, by and large, they mean one and the same. If any advance is taken for a sale of an immovable property and the agreement is cancelled, not necessarily only an immovable property, sale of any capital asset, an advance is taken and the advance gets forfeited or the agreement falls through, the entire advance is reduced from the cost of acquisition or the indexed cost of acquisition as the or the cost of improvement. In the earlier case, it was the indexed cost of acquisition, as the case may be, or the indexed cost of improvement as well in the computation provision. Now 51 says, as a proviso also, which says, suppose the advance forfeited is taxed as income from other sources under section 56(2)(9), then 51 will not come into picture. Under 56(2) subclause 9, it says that any such advance which is forfeited etc. will be taxed as income from other sources. In most of the agreements which happen in the real world, the fact if an advance taken is gets forfeited or not comes into the computation only at the time of sale, and in very rare cases with the AIS information etc., it can be pulled out by the department and the question of taxability of income from other sources may be raised under section 56(2)(9). Now that is a separate part. Let's understand the ramification of this clause in the new computation provision. I'll give you an illustration. Suppose the sale consideration is 100. The cost of acquisition was 10 and the advance taken was 12. That leads an anomalous situation wherein the cost of acquisition will going forward, the cost of acquisition will need to be read as 10 minus 12 as minus 2. So an assessee may take a stand telling the cost of acquisition can never be a negative number. Such a point has never been envisaged in the law. So 100 minus 0 is what I am supposed to pay the capital gains tax. Whereas the revenue may take a stand there telling that 100 minus of minus 2, 102 is the taxing base on which you are liable for long-term capital gains tax. I think sooner or later a clarification on this, or probably an amendment will need to be brought in linking it to section 51 as well as to 56(2)(9, probably in the before the finance bill gets enacted. This is one point which is on the separate side. Secondly, under section 242A, the term of a long-term capital asset and a short-term capital asset is being brought in on a uniform basis, but nobody thought about 50B, which is a slum sale provision. In slum sale, it still remains as 36 months only, wherein any sale of a business under the slum sale provision, if it is held for less than 36 months, will be treated as a short-term capital asset, and if it is held for more than 36 months, it will be treated as a long-term capital asset. This issue of negative cost of acquisition also is running pending adjudication with the Supreme Court in the case of Sumit Securities, wherein the stand of the revenue was under slum sale was, if 100 was the sale consideration and the net worth was a negative number, meaning the company had only accumulated losses or the erosion, complete net worth had got eroded to the extent of, let us say, 10. The departmental stand was the computation provision will need to be read in such a way, 100 minus of minus 10, on 110 you are supposed to pay the tax. This was the stand which is pending adjudication before the Supreme Court, while the assessee stand was, it will have to be read as 100 minus 0 because the section does not envisage a negative cost of acquisition or a negative net worth in the computation. So the net result is, the assessee stand is, I will have to pay a capital gains of 100. The same principle may come into picture under normal long-term capital gains computation as well. I think it is time sometimes when the amendments are being made, a relook at existing provision is a sine qua non. Otherwise, we are going to end up with such types of issues in the coming days. Now, how did this? Why or what happened to this issue of negative cost of acquisition, or why does this does not happen in the erstwhile or the indexation scheme of calculation of capital gains? The answer is obvious. The indexation buttressed the advances whatever were taken, and the possibility of something going into a negative number was virtually impossible. Okay, right. We'll see some more of these amendments or the fine prints in the coming days. Thank you.